Let us come to this wonderful standard IAS 28. What is IAS 28? Investment in associates and joint ventures. Okay. So this standard covers investment in associate and joint venture. Special treatment that we are going to give under this standard. It will not be just simply an accounting of investment, that is investment to bank and then maybe just change the fair value. That you don't do here. Here you will have to also ensure that the performance of the associate and joint ventures are reflected in your books. Investment in associate is usually 20% or more of the shares of that company. So you have the power to participate and influence the decision making process of that company. It is not enough just to know how much dividend we have received from associate. Is it right? If I apply other standards, then I will only be able to show two numbers in the financial statement. One, dividend received, and second, the carrying amount of investment. But we don't really know how these entities are performing. To have a better understanding of the performance of the associate, where we have significant influence, and to have a better understanding of the performance of joint venture, where we have joint control, this standard says you also bring the performance of associate and joint venture in the reporting entity's financial statement. So if they make more profit, you will show your share in profit. If they suffer losses, you will show your share in those losses. So this will help us to understand the performance of the entire group better, how associates and joint ventures are performing. We can calculate our return on investment also. The stakeholder of the company can put a pressure on the management also, that why you are continuing with such associates and joint ventures. Because as the value of the current year will change compared to last year, we'll be able to see how much rate of return we have made on those investments. And therefore management will be more careful while routing the money through associates and joint venture, because their performance also gets reflected in our books. This standard is applicable for both accounting for associate and accounting for joint venture. Joint arrangements are of two types. Which two types? Joint venture and joint operation. If it is joint operation, which standard will take care of that? IFRS 11. And if it is joint venture, then this standard. Okay. And what is the name of the method of consolidation? Equity method. So we'll discuss in a while what is equity method. Next question is, who is an associate? Who is an associate? Associate is an entity over which the investor has significant influence. So what is the key word here? Significant influence. These are very subjective terms. These are very subjective terms. What is significant influence? So they have defined significant influence also. But first I will tell you a small trick to identify an associate. We have a lot of investment. You have hundreds of investment made. And then your boss says, article, go and find out who are the associates of this company. So first you make a list of all the investment that you can easily get from the accounting record. Then check where do we have significant influence. We'll discuss the meaning in a while. And then check where we don't have significant influence or significant influence. No significant influence, not an associate. Significant influence can also be over subsidiary, because there we have more than significant influence. It means it can't be an associate. We also have significant influence over joint ventures. We influence them also, but they are joint ventures. So they are also not associate. We have significant influence, but it is neither subsidiary nor joint venture. Then all such other investment will be called associates. Okay, so they will become associate. Come back to this standard, apply this standard. Now next question is, what is equity method of accounting? So this is a very simple standard. If you understand this basic thing only, most of my task is done. Equity method is a method of accounting where the investment will be initially recognized at cost. Investment will be initially recognized at cost. So entry for that will be investment account debit to bank account. Investment will be initially recognized at cost. And thereafter, as the net asset of the investee will change, that is associate will change, you will make a corresponding impact in the carrying amount of investment for your share only. So if their net asset has changed from 1 lakh to 2 lakh, your share in that is 1 lakh into say 20%. So you will increase the carrying amount of investment. Investment account debit to consolidated profit and loss account. What if there is a loss? Reverse the entry. Consolidated P&L account to investment. So now what will happen in this entry, you can visualize, as the associate will make more and more profit, it will get reflected in your financial statement also. Reverse, if they suffer losses, incur losses, that will also get reflected in your financial statement. If this standard is not there, then this entry will not be required. So you will continue to see cost amount every year, because IAS 27 separate financial statement will be applied, and that standard says investment can be either carried at cost or at fair value or as per equity method. So I will choose cost method only, and I will continue to show for many years at cost. My own stakeholders don't know what is happening in the associate company. Is it right? Then the student can ask, then why don't we consolidate their assets and liabilities with our books also? Suppose we just have 20% stake, but that is too low a stake to claim a stake in the net asset of that company. Is it right? Because 80% may be with others. So we can't go to the extent of recording the entire net asset of the associate, because we just have significant influence. We might be just one director out of 7. Okay. So our involvement with the associate is much lower compared to our involvement with the subsidiary. Our control or our influence over associate is much lower than our influence over the subsidiary. So standard says don't consolidate the assets and liabilities. You want to know the performance? We are giving you a method how to check the performance. Take your share and record in your book. So if they make more profit, your investment value goes up. If they suffer losses, your investment value will come down. Sometimes what happens, point number last on the screen, there may be some transactions which are recorded in the OCI of the associate. Some example of item which are directly written in OCI of the associate: revaluation gain, actuarial gain, designated financial asset instruments, okay, cash flow hedge reserve. So those items, if they have passed entry in their OCI, I will also pass an entry, investment account debit to consolidated OCI account. So whatever reserve they create, we will also give a corresponding effect in our books, and this will continue. That's it, done. Chapter is over. Go home. Okay. So now see the definitions. Some definitions I will not read again. Associate is done. Consolidated financial statement we know. Equity method I have just now explained. Now next is definition of joint control. This definition is same as in IFRS 11. Is the contractually agreed sharing of control over an arrangement which exists only when decisions about the relevant activities require the unanimous consent of the parties sharing the control. Okay. So that means there must be two or more parties. They must share joint control, and the decisions relating to relevant activities require unanimous consent. More about joint control, please revise your which standard? IFRS 11. And what is joint venture? Is a joint arrangement. It is a type of joint arrangement where the parties that have joint control of the arrangement have the right to net asset of the arrangement, not to individual assets or individual liability, but they have a right in the net asset of the arrangement. Normally, joint venture is in the form of a separate legal entity. Next is who is a joint venturer? Is a party to a joint venture, and he must have joint control of that joint venture. So then he's called joint venturer. Welcome, you will also apply IAS 28 if you are a joint venturer. And then what is significant influence? One of the key words in this standard is significant influence is the power. But how much power? Same like IFRS 10 or lower than that? Lower. In IFRS, the power to direct the relevant activity. Here it is power to participate, only participate. Okay. So you come, you participate, but you can't direct the relevant activity. You can't tell the associate, you stop producing this item. Associate will say there is 80% share held by others also. So I'm not just going to listen to you. At least you can tell that much power you have, but he will not follow your instruction. So, but power to participate is also something which is very important in corporate world. Okay. If you are a one board member out of 10, then your one vote also sometimes counts, matters. You are party to the decision making process in board meeting. Of course, you can't take the decision, but at least you can participate, you can influence the financial and operating policy. Now, this standard uses the word and. You should have the power to participate in both financial policies also, operating policies also. Financial policies relate to matters of finance like dividend policy, capital structure, buyback of share, conversion of debenture, etc. And operating policies related to sales, cost, price, distribution, marketing, human resource, okay, mode of disposal, etc. Decisions, but is not control or joint control. If you have control, then apply IFRS 10. And if you have joint control, then apply either IFRS 11 or this standard again, but as a joint venturer. So that is the meaning of significant influence, power to participate, but not control. If you have to check whether an entity has significant influence or not, then the standard gives you a benchmark. What is that benchmark? If you are holding, say, more than 20% share in the voting power, so you are on this side. So the assumption is you exercise significant influence unless proved otherwise. Unless proved otherwise. And if you are on this side of the boundary, no significant influence. Again, unless proved otherwise. Then what is the use of this? This gives you, you can say, a rough benchmark. Okay, at least if you see around 20% stake in a company, your client is holding 20% share of another company, pause and check for significant influence. But with more than 20% also, if you can prove it is a reputable presumption, that means the assumption can be challenged, that you do not participate in financial and operating policies, then you are not required to apply this standard. Like for example, bank has given loan to a company has not repaid the loan. What bank did? Converted loan into equity. Now they are holding 20% equity share of that company, but they are not participating in the operating and financial policies. So then they can say that since we are not participating in financial and operating policy, we will not apply this standard. What about less than 20%? You are on this side, but other shareholding is scattered. Individuals are holding only 0.1%, 0.5%, 1%, 2%. So remaining shareholding is widely scattered. And with 17% or 18% also, you are able to influence the operating and financial policies. Will you apply the standard? Yes. Okay. So when you are a student and you find 20% or more and problem is silent, and it is neither a subsidiary nor a joint venture, even if it is joint venture, you could do the same thing. That is also not a very serious matter now. But the moment you see 20% or more, you may assume that significant influence exists. You can't write a note, we assume there is no significant influence, hence investment will be carried at cost. Okay, now we'll just see whether you are listening or not. S Limited and P Limited hold 15% equity each in G Limited. P Limited is already a subsidiary of G Limited. Okay. There is another company, G. This is P. P is a subsidiary of S. And both are holding 15% each. P Limited is already subsidiary of S. Is G Limited an associate of S Limited? Now see the definition of this 20%. If you are directly or indirectly through subsidiary holding more than 20% share in voting power, then it is presumed that there is a significant influence unless proved otherwise. So you have to write the answer that S Limited plus its subsidiary P Limited together hold 30% share in G. It will be presumed that there is significant influence unless proved otherwise. Next example. S Limited owns 60% share of M. So M is a subsidiary. M Limited owns 30% share of S. That means this time the entire shareholding in subsidiary is through entire shareholding in associate S Limited is through a subsidiary M. The question is same. Will this make this L Limited an associate of S Limited? Same answer. If a company directly or indirectly through its subsidiary holds more than 20% share, it is assumed that there is a significant influence unless proved otherwise. Now one more example. This is more tricky now. X Limited holds 6% share in Y. Z Limited holds 8% share in Y. Z is a subsidiary of X. So in this example, X and its subsidiary Z together hold 14% share in Y. Agreed? But the notes is important here. Z virtually takes part in the most of the operating and financial decisions of Y. So X through its subsidiary Z is participating in financial and operating decisions of Y. Whether Y is an associate of X. Yes, Y is an associate of X because X has significant influence over Y. So in this example, even we are holding less than 20% share, but it can be proved that there is a significant influence. Now next is, how do we check whether there is significant influence? Whether one party is exercising significant influence over other party or not. Again, the standard has given 5, you can say, illustration or examples. This list is not exhaustive because this is a very subjective matter. Significant influence. The existence of significant influence by an entity is usually evidenced in one or more of the following ways. Usually means most of the time if you come across this kind of transaction between two entities, then you can go with the assumption that there is a significant influence, of course unless proved otherwise. The best test is the first one, representation on the board of directors or equivalent governing body of the investee. Again, one has to see the entire facts and circumstances to come to a conclusion that this board member can have a significant influence. Okay, because board members usually participate in decision making process, and sometimes their one vote can make a impact on the decision. 5 directors are there, 2 on yes, 2 on no side, then this one vote matters. Okay, you will not know, but there was a government of Atal Bihari Vajpayee. Okay, 545 seats are there in Lok Sabha of Parliament in India, and then he was fighting for the vote of confidence, and I had seen that program live on the TV. Exactly half and half vote were divided, and then one vote of speaker would have decided the next 5 years of that government. Is it right? And the speaker voted against the government. After 11 days only the government had collapsed. Again re-election. Right? So your one vote matters. Next line. Participation in the policy making process. In companies there are many what they call committees, and they take policy decisions. Like for example, audit committee, remuneration committee, ethics committee, technical committee, okay, corporate governance committee. These people, they take important decisions relating to company because board of directors cannot meet frequently. So then some task is assigned to a group of committees, group of people, they are called committees. So if you are participating in one of these important committees, you are influencing the decision making process. Third is through material transactions. Material means significant volume of your transaction is with other entity. Like for example, you purchase 100% of the output of investee. So you have significant influence over it. Then you provide managerial personnel to other entity, interchange of managerial personnel. All key functions of associate are looked after by your key managerial personnel also. So in many companies, if you have done audit of large company, in associate subsidiaries, there are few people from parent company who are actually sitting and doing all the key functions. And then you also supply essential technical information. So the other party is dependent on you for technology. And through technology, you have an influence over the other entity. This list is not exhaustive. One or more of these features may exist between investor and investee. And if you come across such relationship between the two entities, then you can ask the investor entity that you have to apply this standard. Okay. What is the method of accounting for investment known as? They have called it equity method. Some discussion. When you acquire the associate, on the date of acquisition, you will do a calculation called goodwill or gain on bargain purchase. Goodwill or gain on bargain purchase. And how do you do the calculation? You will compute cost of investment. You will compute entity's share in the net fair value of the investee's identifiable assets and liabilities. Here also will take fair value. Now this time you will apply the same principle which you apply in IFRS 10. Is it right? For calculating the net asset. We are not required to compute NCI here today. Okay. NCI is not required in calculation. Compare the two. Cost with share in net asset. Okay. So there are two possibilities. Cost is more than net asset, goodwill. Cost is less than net asset, gain on bargain purchase. If it give rise to goodwill, for example, then it will be included in the carrying amount of the investment. Then what we have to do? Don't do anything. No, don't disclose also. No disclosure of goodwill in case of associate and joint venture. It remains included in the carrying amount of investment. No disclosure. No. Yes. Disclosure was required in Indian GAAP. That was AS 23. Okay. But here, if it is goodwill, don't do anything. Suppose you purchase the investment for 110 and it may include a goodwill of 10. So you just write investment 110. Nothing more. Don't impair the goodwill also separately. Don't show goodwill as a separate asset also. Forget it. Okay. But if suppose it results into a negative situation, cost is 100, share in net asset 110, so difference is 10. This is called gain on bargain purchase, gain on acquisition. This will be transferred to profit and loss under this standard, IFRS or in IAS 28. So what you will do, you will pass entry like this. Investment account debit 110. This 110 to cash 100. This 100 cash paid, and to profit and loss. You will take in profit and loss 10. So here I am adjusting the carrying amount of the investment. We will increase it to the extent of gain on bargain purchase, and that gain will be recognized in profit and loss. Any excess of the entity's share of the net fair value of the investee's identifiable asset and liabilities over the cost of the investment is recognized in profit and loss account in the period in which the investment is acquired. So what is the formula? Once again, we'll just revise quickly. In case of goodwill, cost of investment will be compared with net asset. A is greater than B. Goodwill, positive goodwill is already included in the cost of investment and so needs no further accounting treatment. No disclosure also. In case cost of investment is greater than share in net asset, it is gain on bargain purchase. Gain on bargain purchase will be recognized in profit and loss in the period in which the investment is acquired. Goodwill is not amortized and goodwill is not separately impaired also. The whole investment will be tested for impairment. The whole investment, when you test for impairment, means goodwill indirectly also gets impaired, if any. Now equity method again. Investment will be recognized initially at cost, investment to bank. But if there is a gain on bargain purchase, then one more entry, investment to gain on bargain purchase transferred to P&L account. The carrying amount is decreased or increased by the following adjustments. On every reporting date, check what is the change in the net asset of the associate or joint venture. Change in net asset can be either due to change in profit or loss, or due to change in OCI, or due to some item directly recorded in equity. So if they have made profit during the year, your share in the profit you will calculate investment account debit to consolidated P&L account. If they have made some changes in OCI, your share in that calculate investment to OCI. If you have received any dividend from investee, then reduce it from the carrying amount of the investment. All these adjustments we are telling in under IAS 28. Under IAS 27, the treatment will be done accordingly. Okay. So in this standard, bank account debit to investment, this sometimes causes confusion. Why we are crediting investment account? Read the previous entry. Investment to consolidated P&L account. When the investee earns profit, your share goes up in the net asset. So investment goes up. When the investee pays dividend, their net asset comes down. So your carrying amount of investment also will be reduced. If you write bank to P&L account, there is a double entry in the P&L account. One for your share in the profit and second is your share in dividend also. So a profit and loss account gets double impact for the same profit. But that is wrong. So we will always see if their net asset goes up, our investment goes up. If their net asset falls, our investment value will fall. Adjustment to the carrying amount may also be necessary for changes in the investor's proportionate interest in the investee arising from changes in investee's other comprehensive income. Like for example, revaluation gain or loss on PPE, foreign exchange translation difference, and actuarial gain or loss. Then fair value gain or loss recognized through OCI. Then hedging reserve routed through OCI. You will also give the effect in your corresponding OCI. The investor's share of those changes is recognized in investor's OCI as per IAS 1 presentation. Now we'll solve one problem. Okay. So solve very easy problem. ABC Limited holds 25% shares in PQR at a cost of rupees 10 lakh. So first they will capitalize investment at 10 lakh. There was no goodwill or capital reserve, no goodwill or gain on bargain purchase at the date of acquisition. So that means your cost and share in net asset was same. The total share capital of PQR was 40 lakh And for the current year, it earned a profit of 6 lakh, out of which dividend of 10% was paid. Find out the amount to be shown by ABC Limited in the CFS as investment in associate. So first we will capitalize at cost 10 lakh. Add share in profit. Profit is 6 lakh into 25%. How much? 1,50,000 add. And then 10% of share capital is paid as dividend. 40 lakh into 10%. 4 lakh. But your share is only 25%. Into 25%. How much dividend was received? Minus 1 lakh. So the carrying amount of the investment would be 10,50,000 for IAS 28 purpose. Is it right? You want to solve one more problem? Yes, one more. XYZ acquired 30% equity share capital of Dev at a cost of 6 lakh. On the date of acquisition, the balance sheet of Dev Limited showed the following position: share capital, general reserve, securities premium. So total is how much? 15 lakh. 15 lakh into 30%. What is share in net asset? 6 lakh is cost. 15 lakh into 30%. Just check whether there is goodwill or gain on bargain purchase. So then ignore. This is coming to 4,50,000. Only you should confirm whether it is goodwill or gain on bargain purchase. If it is goodwill, no further treatment is required. Then Dev Limited made a profit of 2,50,000 and declared a dividend at the rate of 15% on the share capital. Find out the amount at which investment in associate will be shown by XYZ Limited in the CFS. Now the problem is similar to previous one. 6 lakh is the cost. Share in profit 2,50,000 into 30%, 75,000. And then dividend received 15% into 10 lakh into 30%, 45,000 minus. So the carrying amount of investment under IAS 28, 6 lakh 30,000. Sure. Okay. So now we'll continue in the next lecture.